Welcome to another session with Tankrich. This is our series on lessons from Warren Buffett shareholder letters. And if this is your first video, what I would recommend is you can go back to our introduction video and understand what is our intent from these videos and what are we trying to convey through these videos. So today we're going to talk about 1961 letter that was during the partnership years, and I've got that letter with me today. What I really want you to focus today is on three important lessons that we have got from the 1961 letter, and then obviously you can go back and read this letter and see if you have few more which you have got, and then share them in the comments section. So without wasting further time, what I would do is I'll straight away jump into the first lesson. The first lesson which we got from the 1961 letter was the power of passive investing. Now, you'd be thinking, here is a guy who is beating markets year on year with a very large difference, so almost at 10%, 8%, and even when you look today at 50 years, Warren Buffett has really murdered S&P. But what is the advice that he's giving to small retail investors? And this is where this letter talks about a very key message. He says that what he does was he presents the data of returns that investors would have got when they would have invested in large mutual funds, or if they would have invested in Dow, which was the index in America at that point of time, which he used to judge his performance on. And obviously he was also putting in what he was achieving as a limited partner during those partnership years. And I would tend to quote him. He says that I present this data to indicate that Dow as an investment competitor is no pushover. So mark the word pushover. And the great bulk of investment funds in the country are going to have a difficulty in bettering or perhaps even matching its performance. So an investment horizon which is beyond five years. As a small investor, you would really benefit by doing index investing instead of really focusing and finding undervalued situations or undervalued stocks. So that was one key message which we got, first key message which we got from Warren Buffett in the 1961 letter, and I think this is a very key one for retail investors. If given a choice, go for index investing if you're not really having time to find undervalued securities. Now, the second lesson, and this is probably is going to take the most of our time in this video today, because for the very first time in 1961, Warren Buffett talked about what are the various stocks or what are the various blocks where he invests, or how we would classify or categorize his investment situations. Obviously, he talked about briefly about them in his earlier letters, but in this letter he really penned down and provided definition to all the partners and public in general on what his thought process was, how did he categorize all his investments. So what were those types? There were three types wherein he invested. The first were generals. Now I'll probably refer to the letter again and again because he's put concrete definitions on the types of investment and the categorization. So generals this is what he has to say about generals. The first section consists of generally undervalued securities, referred as generals, where we have nothing to say about corporate policies and no timetable as to when the undervaluation may correct itself. Over the years, this has been our largest category of investment, and more money has been made here than in either of the other categories. We usually have fairly large positions in each of the 5 or 6 journals, with smaller position in 10 to 15. So journals where he referred to journals was he had investment in securities which were trading below their intrinsic value. Those were called as journals as a first categorization of the securities where he invested. Now, very easy to understand. The key point here was the time which will take a journal move from an undervalued category to a fairly valued or overvalued category was not in control of Warren Buffett. But the second thing which he wanted to mention was he had made most of his money by buying undervalued securities. That's key lesson for us. If you make your buying right, you don't have to worry about selling because you've done the job well in the beginning itself. Now, now listen to this. We do not go into these journals with idea of getting the last nickel, but are usually quite content selling out at some intermediate level between our purchase price and what we regard as fair values. So you've talked about investment gurus of buying things at low and then selling at the top. Not possible in equity market always. So what you should do is buy securities at undervalued, or when they are undervalued, and then try to sell them when you think your fair value estimates have been reached. Obviously, you have to think through that, has the fair value changed? Have there are situations in the business which demands the fair value to be increased? But don't try to sell at top, because many times you won't be able to do that. That's the key lesson we got from the categorization of securities which were journals in his portfolio. The second category was workouts. Now, what were workouts? Workouts were pretty simple. This was the portion of portfolio which was allocated to securities where a corporate action would result in a profitable outcome. What could be that corporate action? That could be very simple, like a write offer, or a buyback, or a merger, or a spin off. So even if the market went up or down, that did not impact the profitable outcome for that particular company, because the reason Warren Buffett invested in that company was he wanted a corporate action to trigger off a profitable outcome for him, and he actually used this as a hedge uh, in bear markets. So in bear markets, usually all the journals will go down, but if you have a portion of your portfolio in workouts, you will get a profitable outcome, because workouts are not related to what's happening in the general market. So this is where his second categorization was done, wherein he was putting enough amount of money in workout situations. And I would tend to quote him again. It says that these are securities whose financial results depend on corporate action rather than supply and demand factors created by buyers and sellers of those securities. So very clearly, workouts would work out irrespective of market situation, and he would tend to keep a certain portion of his portfolio in the workout securities. Now, very interesting. What we got from the workout was Warren Buffett used leverage. Now, he is not using leverage for general issues, but he was using leverage on the workout situations. And I'll again quote him from the letter. I believe in using borrowed money to offset a portion of workout portfolio since there is a high degree of safety. Mark the words, high degree of safety in this category in terms of both eventual results and intermediate market behavior. So if you have really spotted a workout situation, you can go for leverage money like Warren Buffett did. However, now as I stand back and reflect on it, should a retail investor do it? Not every one of us is Warren Buffett, who understands the nitty-gritties of situations and is able to understand and put a value to a workout situation. So I would still refrain from uh, getting onto a leverage and then get that leverage money into my workout portfolio. But what I would still do is I'll put my own money in the workout portfolio, because they would tend to do better irrespective of market situations. And the third and the final category of his investments were control situations. Like many of us would not be lucky to get into control situations where we'll actually control a company, where we can control their operating decisions, their investment decisions, and things like that. But for Warren Buffett, he was lucky, and he made those decisions where he could get into the control situations and affect the operating and investment operating and investment policies of the companies, which led to the profitable outcome for him. So, so he really had three categories where he invested: journals, workouts, and control situations. Now, finally, again, in this letter itself, there was a soft issue which was discussed, which was around what really is conservatism, and he used Dempster Mill manufacturing as an example to convey his thoughts on that, and I would again quote him from the letter. Now, he really didn't wanted to ride uh, on exorbitant valuations when he was taking new partners, or when the old partners were selling out. So he really wanted to calculate the fair value of the controlling interest he had in the Dempster Mill manufacturing company, and I would again quote him from that letter. How did he see valuation which would be fair to both the new members and the old members? He said that the estimated value should not be what we hope it would be worth, or what it might be worth to an eager buyer. Mark, eager buyer. But I would estimate our interest would bring if sold under current condition in a reasonably short period of time. So he wanted the controlling interest to be valued very conservatively. He did not want it to be valued valued it to be exorbitantly by putting that controlling interest to an eager buyer. Obviously, an eager buyer would be willing to pay a lot more than what you could get in a short period of time. So he was really conservative in his valuations. That meant that he can only go right in one direction when the conservatism would pay off, and there will be very less downside risk even for the people who are buying into his partnership. And these are my three key takeaways from the 1961 letter, Power of Passive Investing. Second one was, how did Warren Buffett categorized his investments, and the third one was, what were his thoughts on conservatism.